Good morning, ladies and gentlemen. Welcome to the Shriram City Union Finance Limited Q1 FY23 results conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kunal Shah from ICICI Securities. Thank you, and over to you, sir.
Thank you, Lizan, and good morning, everyone present on the call. This is Kunal Shah from ICICI Securities. Today we have with us Mr. Y.S. Chakraborty, MD and CEO of Shriram City Union Finance, Mr. R. Chandrasekhar, ED and CFO, Shriram City Union Finance, Mr. Ravi Subramaniam, MD and CEO of Shriram Housing Finance, and Mr. G.S. Agarwal, CFO from Shriram Housing Finance, to discuss their Q1 FY23 earnings and also to give the business updates. Yeah, over to you, sir.
Thank you, Kunal. Good morning, friends, and welcome to the earning call of Shriram City Union Finance Limited for the first quarter of financial year 2023. We have declared our results for the quarter yesterday evening, and these, along with our investor presentation, are available for perusal on our website as well as on that of the exchanges. I hope you have had the opportunity to read through the details, as they will form the backdrop for our earnings call today and the Q&A to follow. We have registered some of our best ever metrics in Q1 FY23. Even if it is taken into account that the same quarter last year was affected by the second wave of COVID-19, we bettered our performance over last quarter as well. Beginning last quarter, that is Q4 FY22, we seem to have reached a new normal on the disbursement front, and this is good news because I believe that we should now consistently look at clocking quarterly disbursement levels in excess of 7,500 crores, a number which until last calendar year we have achieved only once, and that too in a festival season quarter, when disbursements anyway tend to be higher. Before I move into the operating details, I would like to give you an update on the proposed merger of Shriram City Union Finance and Shriram Transport Finance Company, which will lead to the birth of Shriram Finance Limited. We have made good progress in the matter of statutory and regulatory approvals. The merger has been green-lighted by SEBI, the stock exchanges, Reserve Bank of India, our shareholders, our secured and unsecured creditors. We also received a go-ahead from the insurance IRDA, that is the Insurance Regulatory and Development Authority. So as of now, what is pending is a clearance from Competition Commission of India and the National Company Law Tribunal. We are hopeful of these approvals coming in over the next couple of months. In the interim, we have already begun the process of assigning responsibilities to geographical unit heads and their immediate juniors, besides orienting the business teams of both Shriram City and Shriram Transport to the products and lending nuances of both the companies. Currently, the orientation process, which began in April as a pilot project in about 50 branches, has now been rolled out to around additional 500 branches of both companies. The integration of IT systems is also progressing well, and thus we will be able to hit the ground running as a merged unit when we are in a position to announce the final merger. Now for the business performance. First, a quick read through the consolidated numbers. That is after including the performance of our housing finance subsidiary. Our consolidated disbursements for the quarter stood at 8,726 crores, a growth of 82% year-on-year. Consolidated AUM crossed 40,000 crores and stood at 40,414 crores, a year-on-year growth of 21% and a quarter-on-quarter growth of 5%. Consolidated operating income at 2,003 crores grew by 24.2% year-on-year and 5.7% sequentially. Consolidated net interest income was up 29% YOY and 10.3% quarter-on-quarter. Consolidated pre-provision profits were higher, almost 20% YOY and 12% QOQ. While consolidated net profit was up a healthy 60.9% YOY and 8.6% sequentially. It is also pertinent to note that on the housing finance side, they have disbursed in this quarter what they have disbursed for the first 6 months of the last year. So, housing finance continues to grow well. Now, on the standalone AUM for SCAF, it is 34,611 crores, a growth of 16.9% YOY and 4.3% quarter-on-quarter. SME loans, two-wheeler loans, personal loans and gold loans continue to be the growth driver for us. Over the next couple of years, we expect our digital offerings in these products to also contribute meaningfully to the loan book. Just to reiterate what I had mentioned in our earlier interactions, we have introduced contactless and paperless two-wheeler loans as well as digital personal loans and are in the process of developing a digital model for our gold loans as well. We also did very well on the profitability front. Our PBT and PAT at 431 crores and 323 crores respectively are our highest ever, as are our pre-provision profits. We maintained our loan yields about 21%. Interest income for the quarter was 1,843 crores, again our best ever, and grew 23.2% YOY and 5.2% sequentially. Net interest income too was higher by 26.2% YOY and 9.9% quarter-on-quarter. Despite the overall higher interest rate regime, net interest margins were the highest in 15 quarters, having come in at 13.71%. Our collection strengths were again evident in our collection efficiency in the quarter, which came in at 104%. The positive effect of this was seen in our gross stage 3 delinquencies, which further declined to 6.11%. We maintained a provisioning coverage of 47.13%. Credit cost declined to 2.68% in the quarter from 3.92% a year ago. The continuing improvement in credit quality enabled us to further write back some of our COVID-related provisioning, and this stood at rupees 339 crores as at the end of the quarter. While we continued with the same number of branches in the earlier quarter, the higher business metrics prompted us to hire more personnel, and our management quarter stood at 28,829 employees. On the liability side, our overall borrowing in Q1 FY23 stood at rupees 32,921 crores, up from 30,632 crores in the previous quarter. Our incremental borrowings in the quarter were higher by 30.6% Q-on-Q. Our incremental institutional borrowings increased by 35.5% Q-on-Q, and bank funding grew 62.9% quarter-on-quarter. Our retail borrowings also showed a healthy traction. Our fixed deposits have grown 21.8% year-on-year. The door-to-door maturity of our borrowing has increased to 39 months. Since we are preparing for the merger, we considered it prudent to maintain a relatively higher liquidity buffer and hence carried 6,600 crores of free cash and bank balances. Our subsidiary, Shriram Housing Finance, delivered at another strong performance. Besides having reached the second highest disbursement
Yeah, good morning. With reference to your question, I think the performance of the company has improved both on the disbursement, that is one. And also second thing is we are able to do a lot of market borrowings now compared to earlier. And third important, apart from the bank, which is a regular, we get money, plus we also have a lot of fixed deposits. Fixed deposit, if you see for the last 3 years, I think we have doubled our fixed deposit book. And also we are able to borrow at around 8%. So the reason behind why our liability looks much stronger is we are also keep borrowing, no short-term borrowings. We are continuously focusing for last 2 years on the long-term borrowings and also focusing on retail money. And another point is on the question of why the cost of borrowing is strong is because we have now a lot of options available before us. We are able to do securitization. We are able to go with the private sector bank, public sector banks. Retail money is coming, NCDs, MLD. So we are getting into newer markets and newer places, and we are able to bring down the cost. In fact, if you look into the numbers, this quarter, I think our borrowing total interest cost by the borrowings is around 8.59, 8.57. And the fresh borrowings during this quarter, the fresh borrowing around 5,000 crores we borrowed at 8.59. So both the books as well as the fresh borrowing is around 8.5, 8.6. So the company is doing well. We are steadily, or even on the COVID front, collections, everything. So there is a lot of the banks and other people feel that we are in a sound track.
So as far as your personal loan, your question on personal loan is concerned, see, I don't know whether the restructured book in the industry is high or not. You've seen what is Scott's restructured book and the performance of the portfolio. So I do have a full faith and comfort on the two-wheeler portfolio. If you look at the portfolio, the stage 3 gross has come down from 6.5 to about 5.9 in the last 1 year. So that and even the net has declined. So that gives me a lot of confidence. Number one. Number two, book doubling. See, it's a low base, and from there it is double. It has doubled. So that's not a, I would say, not a breakneck speed. It's a low because of the low base. It looks as a percentage terms, it looks high. But if you look at the eligible population of my customers for personal loan, we have more than 2.3 million customers. So we are just scratching the surface here, where our traction is about less than 3-4% of that number. So there is a lot of leeway there to cross-sell personal loan to customers who have completed their loan, or at least they have completed 75% of the two-wheeler loan. On that front, we are very comfortable doing these loans. The other point is you also need to look at is the granularity of the book. It's the personal loan size, ticket size is between 50. Depending on geography to geography, it will be between 50 to 60,000 rupees. So we derive a lot of comfort from the fact that this is going to our own existing customers.
Thank you, sir. And just a follow-up question here. Sir, in the past, the Shriram Group, Shriram City, we have always prided ourselves on that high-touch model, wherein we were very good in physical originations and physical corrections. Now that, you have introduced this contactless digital platforms for two-wheelers, personal loans, and like you said during your opening remarks, we are also in the process of developing a digital model for gold loans as well. Do you think, sir, we have genuinely kind of, leapfrogged over the last 2 years, wherein we are now confident that, even when we kind of do these originations digitally, the asset quality outcome will be as good as what we kind of used to do under a physical high-touch model?
See, I'll put it this way. There are the underwriting actually goes through a different set of parameters for the digital mode. Number one. Number two, we are actually running a pilot for a couple of years on customers that are new to us, and where we are. I would say it's a hybrid mix of digital and physical model. Today we have just eliminated the physics out of it, the physical touch out of it, and converted that into a fully digital model. And it's not that we are running, even in this model, we are not running at a breakneck speed. We are actually piloting this in specific geographies. Each of these products are being piloted, and basing on the learnings of the pilot, we will take a call on whether to push this. How far and how fast we will push this. But I'm pretty confident that if you're looking at gold and two-wheeler, we should be able to actually perform slightly better, because as far as two-wheeler is concerned, I said the credit parameters are stricter for a digital-only disbursement.
Noted, sir. I think this is very, very useful, and sir, wish you and your team the very best, and again, congratulations. We're looking forward to the merger announcement ahead. Thank you so much.
Thank you. We'll move on to the next question. That is on the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Sir, my questions are on two issues. One is in terms of especially your housing finance. What percentage of the loans are floating rate loans, and how vulnerable will the customers be if you try to pass on yield increases because of benchmark linked loans? And to that extent, also in Shriram City, I wanted to know what flexibility would you have to raise rates, and whether the customers can absorb that. The second question is on terms of customer health itself. Are you seeing that post-COVID, the GNPA customers are all coming back because the collection efficiency, like as I said, was over 100%? And do you see this trend continuing? Is the customer health good in your opinion? Thank you.
To answer your first question, all our loans are fixed rate. They are not floating. So whatever is already disbursed, the rates are fixed. It's not going to change. Going forward, if the cost of funds are going to go up for us, we believe that we have the capacity to absorb, say, 25-30 bips of increase in cost without passing it on. Anything beyond that, we would be passing it on. And the segment of customers that we operate in, passing on costs of another 30-40 bips or 50 bips should not be a major issue.
And on the housing loan front, this is Ravi here. On the housing finance front, about roughly 51-52% of our loans are floating, and the balance are fixed. When I say fixed, they are not full tenor fixed, but they are 1 or 2 year fixed. With every passing month, a lot of those will also come up to move to a floating rate regime. So typically, last 1 year origination would be equivalent to fixed, and the balance would be all floating. So repricing will not be a challenge, and
a barometer for me to actually increase my lending in the market.
Excellent, sir. Thank you very much and good luck.
Thank you.
Thank you. The next question is on the line of Varun from Nippon Mutual Fund. Please go ahead.
Yeah, hi. I had a couple of clarificatory questions from me. Just wanted to confirm this collection efficiency number that you gave, so 104%. Do you consider prepayments in that, or is that only current plus overdue collection?
So with reference to collections, what we say is the total TBC, total monthly collectible, plus when we say collections, all money coming into the regular thing, arrears, everything. So total cash flow into the company. So it includes everything.
Okay, so how would that number differ if you...
Payment rates are pretty low. They're in decimals.
Okay. Okay, fine. Okay, so secondly, I just wanted to understand this bit on the cash balance, because I think last couple of quarters that number has been going up. So what is the need that you all perceive that going into the merger that you would need such a high cash balance?
See, basically, initial thought was that once the merger is announced and it's as it progresses, we thought that it will be a little difficult to raise money from the market or from the banks. So we, as a prudent measure, we wanted to have enough buffer before the merger, so that you'll be able to meet the commitments till the merger date.
And is this some? Sorry, go on.
Sorry, yeah.
No. Okay, so is this more from the perspective because you feel that limits may come into question once the merged entity comes in, and that clarity will take some time, or it is just a procedural?
Idea. So the idea here is that till the date of, we were a little unsure what will happen after the announcement of the merger and during the progress towards the merger. Once the merger happens, there is no issue. But till such date, we were a little unsure on how the lenders will react to. So that's the reason why we have actually, shored up our balances. But looks like the lenders are pretty confident, and so this quarter we may actually reduce some of the cash balance.
Got it. No, fair point. Just one or two quick questions I'll slip in. The stage 2 number that we are now reporting is fairly, for some couple of quarters, has been in this, 11-ish sort of range. I think earlier we had managed to bring that down to about 5 to 7%. So how do you look at the stage 2 number going forward? Do you look at this as always being in this range, or is this something which you expect over time, once COVID is well behind us, this number to start coming down gradually?
Stage 2?
Yeah, stage 2.
It's around 11%, right? So see, this is a play between your stage 3 comes down, your stage 2 goes up. Actually, if you look at the numbers, even on the stage 1 side, stage 1 actually has from a 3.37%, on an 81.41% of gross, it has now gone up to 82.26. It's basically stage 1 also improved. So it's whatever improvement that you see in stage 3, where the stage 3 gets pushed to stage 2. And the volume, if you look at the volume in stage 2, it's pretty, as a person, and the net is about 3,800 crores. It's about 10% of the book.
Got it. So we are comfortable at these levels of stage 2.
Yeah.
But historically, see, pre-COVID level, we were around 15-16%. Now post-COVID,
correct.
Actually, post-COVID, the stage 2 has much improved, and I think we should be somewhere between 11 to 12% is what we hope it will be around.
Understood. And just lastly, the stage 3 number that you all have disclosed, that is based on the revised RBI guidelines which they issued and which they've temporarily deferred, or have we gone back to the previous manner of disclosing?
No, as per RBI.
As per RBI, right? Because, got it. Okay, that's all from my side. Thank you.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Sanket from BNK Securities. Please go ahead.
Hello.
Yes, sir.
Yes, sir. So I didn't get your explanation on, say, liquidity improving around this time, and that leading to you having a better cost of funds this quarter. So that's one, some more light in that what actually happened. And secondly, we last 3 years, if you see, 2 years went into consolidation, and last 4-5 quarters are the quarters where we were getting actually our mojo back. But now with the merger, you will be adding 3x of your size of the book, which we have not looked upon recently, and that this has its own structural issues, nuances. So how do you then say guide on growth? We are saying that here in this portfolio 7,500 kind of run rate would continue. But don't you feel there are uncertainties as and when you assume such a big book, and then understanding where to go, how to go about it as far as the growth on overall book is concerned?
Yeah.
See, on the funding side, what happens is, Chandru has mentioned earlier, there are today we were able to take advantage of various channels for funding. One is specifically one good thing that has happened was that our retail focus on retail liability has given us definitely a cost advantage, which is again more than 20% of the book, the public deposit. Similarly, we were able to get a good rates on market-linked debentures and NCDs. Right? So earlier we were heavily dependent on bank funding. Today we have various sources of funding where we were able to take advantage of the availability and negotiate on price.
So is it like that, sir, that NCDs which are maturing this year or which have matured in this quarter, those are still getting replaced at a lower rate compared to the rate at which maybe they were born 3-5 years back?
Yes, correct. One more point is even on the fixed deposit, which is 22% of the book. The earlier book is at earlier we are borrowing at 9%. Now we are borrowing, our average is around interest rate is 7.9. So market borrowings, the earlier is at higher cost, the lower the recent borrowing at lower cost, fixed deposit. So almost 40 to 50% of the book is now at priced. We are able to borrow at some 70, 80 basis point low, and even at the banks we are able to get. So it is basically slow. It is now reflecting in the books what we have done a couple of years back.
Sure, sir. And then the answer to my later question on say growth outlooks.
So see, basically STFC on the merger. So we know, as I've said, this product line will continue to deliver 7,100 crores plus disbursement on a quarter-on-quarter basis. That is set. That stage is set. Even for STFC, I think the Q1 is one of the
used vehicle piece. Now
Sorry?
we had a hello.
Can you repeat? Yeah.
Yeah, sir. So I'm saying for the used vehicle piece, we had a very conducive last 5-6 quarters, wherein on supply side issues on new vehicles were very apparent in terms of chip shortage and semiconductor shortage. But now those things are easing, which should lead to maybe increased supply of new vehicles, and indirectly it should lead to softening pricing or demand in new space. So last 5-6 quarters where it was very conducive, SSTF has not been able to deliver any meaningful growth. So going ahead, you don't think that is only going to soften?
No.
11-12% is a low number that you are talking about, but still I'm just asking. Yeah.
No. What I'm saying is, what I've seen and what I've observed from the book and also spoken to the team is, it's not that they've done badly, but see, the entire supply chain got disrupted, and basically, even used vehicles prices have gone up. New vehicles, of course, there was no replacements. So I don't know why you come to this conclusion of saying that it's been very positive in the sense. I think it's only last 2-3 quarters that the market has picked up, and the sense that I get from my team now is that obviously first quarter is low. The last 2 quarters or the third quarter, fourth quarter also, they will perform reasonably well. So I don't know whether I'm not sure if I got my numbers wrong, but that's what I've seen from whatever I've seen.
So the growth was anyways lagging peers, but anyways, yeah, thanks for the answer.
Thank you. The next question is on the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi, good morning, sir. Thanks for taking my question.
Gaurav, you need to increase, probably pitch your voice up.
Yeah, is it better now?
No.
Sorry to interrupt. Gaurav, you're sounding very soft. I'll request you to speak a bit louder, or can you increase the volume on your instrument?
Sure. Is it better now?
Much better. Thank you.
Okay, thank you. Yeah, good morning, sir, and thanks for taking my question. So my
question Gaurav, once again,
very
you're sounding soft.
Is it better?
It's still the same, Gaurav.
Okay, just a second. Yeah, is it better?
Let's try.
Go on, it's fine, we'll figure out, yeah.
Okay, I'll try, sir. Sir, my question was regarding the borrowing cost. Right now, if I look at it, the borrowing cost has come off. But what is the incremental cost of borrowing for you? And let's say over the next 12 months, what is the weighted average cost of liabilities that would be coming up for maturity, including bonds and public NCDs that you would have raised?
Okay, the cost of borrowing during this quarter is 8.59% for this quarter, and we hope over the next quarter until the rates doesn't go up or RBI doesn't increase it, we hope to maintain at this 8.5 to 8.7. But we are keeping fingers crossed because in fact we have to see the market borrowings. Most of the market borrowings have come over the last 1 year at a lower cost. So the more than which is maturing in this year is just 5-6% of the book. So we don't expect this cost of borrowing to go up steeply, but we have to wait. Q2 we don't expect much impact, but Q3 and Q4 we have to see what RBI is going to do.
So on the maturity, what is the weighted cost?
Yeah, the maturity which is earlier books is something around 8.8 to 9%.
Okay, and you're saying that the total quantum of borrowings which will be maturing is only 6% of the book in this year?
Yeah.
What is the total quantum of borrowing
maturing? As I told you, it will be somewhere around 10 to 12% of the book, maybe around 3,000, 4,000 crores.
Okay, 3,000, 4,000 crore, and the weighted average cost is anywhere between 8.8 to 9%.
Yeah, you are talking about market borrowings, no?
Total borrowings, not market.
Yeah, if we include bank, it will be slightly more. It will be, in fact, it will be 6,000 crores because the weighted average of the book is close to 30 months. So we have 30,000 crores. So around 1,000 crores is the 800 to 1,000 crores will be if we remove retail. So if we remove, so I think if you go up to March, it is going to be 7,800 crores.
Sure. Got it, sir. And so the next question is regarding the cross-sell. There were news articles which suggested that now the cross-sell has increased to over 500 branches across transport and SCUF. So just wanted to understand, how has been the cross-sell both the sides? I mean, SCUF products in STF branches and the small commercial vehicles and other loans of Shriram Transport and SCUF branches. So how has the progress been so far? And any disbursement targets for cross-sell that you would have set across branches?
See, let me put it this way: the cross-sell exercise that let me put it this way: it's not a cross-sell exercise. I would say this is a precursor to the merger on learning. For learning, basically, we are using this as a base for our learning, so that the merger happens seamlessly. What is happening is we call them as a pilot branches rather than cross-sell branches. So these pilot branches, we've started with about 52 branches, and these 52 branches by June have generated close to about something like close to 55 crores worth of leads, which are in various stages of fulfillment. Now, the idea is to sell each other's products in the branches and train the people in these branches so that they will be able to take care of the customer. So this is the aim is to test your front end, test your back office, your back end, and also to see how the tech gets integrated. So now that we have moved it to about 500 branches, it's very early stages. We have moved to another 500 branches only by about second week of July, very early days. But the learnings that we are looking at from the whole exercise is not just numbers, business numbers, but on the exercise towards integrating the front end and the back end. So the learnings and also various issues faced by the teams to smoothen out those issues, so that by on the legal day one we should be ready to roll out basically work on the same tech platform, and the front end also becomes seamless.
Right. And sir, any targets that you would have internally set across branches?
We will not put a target to these teams.
Sure.
The idea is that each of the branches will throughput the initial. It's basically at least a couple of deals they should throughput, so that they'll understand how it is done and we'll also understand what are the issues faced by various different teams for different products.
Sure. But sir, given, just to conclude on this, you're saying the 50 odd branches that we did the pilot on yielded around 55 crore worth of leads. If you extrapolate this to 500 odd branches, let's say 500 branches each, then you're talking about maybe a 2,500 to 3,000 crore worth of disbursements for the full year. Coming from the
No. I said leads. This is not disbursement. Leads.
Sure.
Your leads, 100% of your leads will not turn into a disbursement, boss.
Right.
Leads will drop out. Customers will drop out. Could be in some products there could be. I may find the customer not suitable, or the security is offered may not be suitable. So typically, the lead to conversion will be about 10%.
Oh, okay.
Between 10 to 15%, depending on the product.
Right. All right. And sir, has there been any challenge in cross-selling Shriram Transport products to your SCUF customers, or how has been that specific progress?
There are leads being generated from the SCUF team also. Most of this basically from our SCUF's SME customers who are using vehicles for their captive use Commercial vehicles
Right.
is a captive. We've been there are leads being generated by the SCUF team also on from their own customers there.
Sure, sure. Thanks for that, sir. And just last question from my side was on credit cost. In this quarter, the credit cost was slightly higher because of higher write-offs. For the full year, what kind of credit cost guidance would you like to give? Will it be like 2.5, between 2.5% kind of band, or do you think you can undershoot that?
Yeah, with reference to credit costs, actually, we are to write-off is at the same level. If you see the last 4 to 6 quarters, the write-off is generally in the range between 205 to 215. So this quarter is 218. So it is a similar level to the last 5, 6 quarters. And with reference to your second question of the credit cost, we expect the credit cost to this year to be between 2.5 to 2.7. For last couple of years, our credit cost is 2.9 to 3%. But this year the collections are good and the gross NPA is coming down, and the new book is much old book is going out and new book is much better. So we expect the credit cost to be around 2.5 to 2.7.
Okay, fair enough, sir. Thanks for this. All the best.
Thank you. We'll move on to the next question. That is on the line of Rikin Shah from Credit Suisse. Please go ahead.
Thank you for the opportunity. Most of my questions have been answered. Just one clarification. Wanted to understand in terms of the cross-sell that City Union product is seeing from transport branches. Is that primarily two-wheeler, SME and gold loans only, or there are other products as well? And what are the thoughts relating to developing infrastructure in transport branches to offer the gold loans in future?
You're right. It's mostly SME and two-wheeler. Gold loan, basically, see, you need to offer gold loan. As you said, you need infrastructure there. Infrastructure in the sense you need right now, I think the most crucial is to provide an appraiser in the branch. So train and place an appraiser, gold appraiser in the branch of STFC. That is going on. In fact, as a pilot, we have launched, as I said, we have launched in one branch in Kerala, in STFC, which will probably in the next 15-20 days, we will take it to another 15-20 branches of STFC in Kerala. Karnataka, parts of Karnataka, Chhattisgarh, Madhya Pradesh, the teams are getting trained. So by end of probably August, we should be offering gold loans in about 100 plus branches of STFC.
Got it. That's helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Thank you, sir, for taking my question. So the first question is that do we see any benefit in terms of on the liability cost side post-merger? And if yes, then if you can quantify the same. And secondly, on the merger itself, if you can lay out what are the dates that we are expecting, given that there are 3-4 pending approvals from various regulatory authorities. So if you can give us a timeline of these regulatory approval as well as the final merger timeline that you are expecting as of now.
So I'll answer your second question first. Chandru will answer the first question. On the second timeline, see, I think the most crucial would be the NCLT, because that's where the time we're going to, it'll take some time. But we are, as of today, we are hopeful that by end of September, we should get the NCLT order in. We should get the NCLT order in hand. So I would say, as we stand committed to our original, roadmap that by end of either September or at best by October, we should be a legal entity. So date is, I cannot give you an exact date because it all depends on the bench, NCLT bench sitting.
And what about other approvals like IRDA, CCI, etc.?
See, there are CCI is pending. IRDA, we have received an approval, but there was some spelling mistakes in spelling in the company's name and all. So we have gone back to IRDA for a correction, so that technically it is still pending. You can call it as pending. Probably it's a matter of 3-4 days before we get that. So CCI also we should be able to get it in a short while.
So sometime by end of September or early October, we should trade as a single entity.
Correct.
Okay.
Yeah, with reference to your other question, post-merger liabilities, today SCUF is around 8.6, even STUC is in the same range. But assuming there is no other environment or regulatory or any other Reserve Bank of India thing happening, actually it should be in this range. But if the inflation continues and RBI comes out with harder rates, I think it may go up. But with no other change in the environment, I think it should be somewhere between 8.5 to 8.7.
But because of size and diversification, you don't see any benefits coming to the combined entity.
But that will take time, because over a period of time, because the combined entity is going to have AA plus. So, because we are already, if you see the AA companies, we are one of the best in the industry so far. So over a period of time, there will be definitely benefit on that. But if you ask the current year, we should be in this range.
Thank you and all the best.
Thank you. The next question is from the line of Ashwin Balasubramaniam from HSBC AMC. Please go ahead.
Yeah, hi. My question is on the asset quality in the personal loan book. While it's declined marginally from March, the numbers remain elevated, and especially given the growth in the base. So if I take let's say, lagged kind of number over last year's AUM, it comes to well in excess of about 15%. And also, given that this is a cross-sell product to your existing two-wheeler customer, conceptually, shouldn't the NPA here be kind of lower than the two-wheeler NPA? So, just wanted to understand why the number has been elevated for quite some time now. So, just wanted to understand why.
You're right that conceptually it should be at least, if not lower, at least perform in line with the two-wheeler, at least.
Right.
So the one major reason for this is we have a book where we had this market-driven PL earlier book that is running down. So
okay.
The delinquency percentage is higher. In fact, that's one reason why we have stopped personal loan for some time and then moved into only cross-sell from the market. So probably in the next 3 to 4 quarters, you will see a difference in this personal loan. Like from 11% today, it has come to 9%. So you should see it coming down in the next 3 quarters by at least another 150 basis points plus.
Right, right. But my understanding is that a PL would be more like a fairly short term, let's say 2-year kind of product.
Correct. The cross-sell that we do is about 17-18 months. The earlier book was running into 36 to 48 months.
Okay. So what would be the size of the earlier book?
It will be about 23-24% of the current book.
Okay.
Which should run out probably in the next 1 year or so.
Okay. Thank you.
Thank you.
Thank you. The next question is on the line of Krishnendu Saha from Quantum AMC. Please go ahead.
Yeah, hi. Just a clarification. Currently, there'll be very low single-digit customers of transport with us, right?
Sorry, overlap. You're talking about the overlap?
Yeah, no, customer overlap. Currently, there'll be nil practically, right? Just to clarify.
Practically very, very low.
Oh, okay. No, just clarifying, understanding. What could be the person number be? Any thoughts?
No, in fact, since both the databases are the data we don't have access to the data of each other till now. We have not looked at it, but we have not come across many of them. There are very few. I would say less than 1%.
So, okay. And sir, one more thing about this. What portion of, like, we get a feed as to so many rural branches of Shriram Transport, so 790 whatever centers or whatever. How much for us would be like that, tracking to the same number?
We do, SCUF actually has about 700 plus rural centers.
Yes.
We have about 985 branches and about 700, I wouldn't call them branches, I would say, yeah, if they are small rural centers, actually generate leads and business and pass it on to the nearest branch.
Basically out of 930, 700 and odd is rural. That's what I can gather.
985 branches plus about 700 rural centers.
Yeah. Thank you, sir. Just clarification. Thank you very much.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1.
Last question, please.
Sure, sir. Sir, we don't have any more questions from the participants.
Oh, thank you. Thank you so much. Thanks, everyone.
Thank you. Mr. Shah, would you...
Yeah, sure. Yeah. Thanks, Mr. Chakravarti, for sharing all the insights and senior management team of Shriram City Union Finance as well as Shriram Housing Finance for giving us an opportunity to host the call. And thanks every participants for being there on the call. Have a good day. Thank you.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. We thank you for joining us, and you may now disconnect your line. Thank you.